The $700 reality. The average car payment in America is now over $700 per month. That's the average. Not luxury, not exotic. Average. Add insurance, add gas, add maintenance, and suddenly you're spending over $1,200 a month just to move. But here's the uncomfortable truth. Most people making that payment don't own the car. The bank does, and they're paying interest for the privilege of losing value. That's why this sucks. The normalization effect, financing a car feels responsible. It feels adult. It feels expected. Dealerships assume you'll finance. Friends assume you'll finance. Banks expect you to finance. But normal does not mean optimal. When something becomes culturally accepted, people stop evaluating it critically. Nobody asks, is this the smartest financial move? They ask, what's the monthly payment? That's where the trap begins. The monthly payment psychology. Dealerships don't sell cars, they sell payments. You walk in focused on price. You walk out focused on monthly comfort. That psychological shift disconnects you from total cost. A $42,000 car at 7% interest over 72 months? You'll likely pay over $50,000 total. But you don't feel $50,000. You feel $720 per month. That's how financial pain gets disguised. Interest on a depreciating asset. Here's the brutal math. You are paying interest on something guaranteed to decline in value. Cars lose 15 to 20% in the first year. By year 5, often 50 to 60% gone. So you're paying interest on shrinking value. Imagine borrowing money to buy an ice cube and paying rent while it melts. That's auto financing in slow motion. Negative equity, the hidden prison. When your loan balance is higher than your car's value, you're upside down. This is negative equity, and it's extremely common. If you try to sell the car, you still owe money. If you trade it in, that negative balance gets rolled into your next loan. Debt stacks on debt. The prison expands quietly. The long-term loan trap. Car loans used to be 3 to 4 years. Now 6 to 7 years is common. Why? Because longer terms reduce monthly payments, but they increase total interest time in debt. Financial rigidity. You commit income years into the future before you know what your future looks like. That's risk most people underestimate. The true monthly stack. The car payment is just the entry cost. Let's stack reality. $720 payment, $220 insurance, $200 fuel, $120 maintenance, $50 taxes / registration. That's roughly $1,310 per month. That's over $15,000 per year. Over 6 years, nearly $90,000 total transportation cost for something losing value every day. Opportunity cost. The silent loss. Now imagine redirecting $700 per month into investments. At 8% annual return, 6 years to around $60,000, 10 years to over $120,000. That's wealth building. Instead, the money evaporates through depreciation. The real loss isn't the payment, it's the future you delayed. Why banks love auto loans. Auto loans are profitable, low default rates, physical collateral, predictable payments. And here's the key. In America, cars are necessary. Without one, job access shrinks, mobility shrinks, income potential shrinks. So borrowers prioritize car payments above almost everything. That reliability makes banks comfortable and profitable. The emergency factor, debt limits flexibility. If you lose your job, you face medical expenses, you need to relocate, the payment remains, interest remains, depreciation remains. Long-term car debt increases financial fragility during crisis. Resilience decreases as commitment increases. The status illusion. Cars signal identity, stability, progress, achievement. People stretch budgets to look secure. But many financially secure individuals avoid large auto debt. They prioritize liquidity, they prioritize investment, they prioritize flexibility. Meanwhile, middle-income earners often finance image. That gap between perception and reality, that's expensive. Inflation and wage stagnation. Car prices have risen significantly in recent years, but wages have not kept pace equally. Therefore, loan terms extend, interest accumulates, debt duration increases. The financing system adapts to affordability pressure by stretching time, and stretching time increases total cost. The dependency loop. Here's how cycles form. You finance. You build equity slowly. You trade in early. You roll negative balance. You restart. Each cycle adds cost. Each cycle reduces long-term net worth. And because it feels like normal upgrading, the cost feels invisible until you calculate it. The final truth. So why does it suck to finance a car in America? Because you normalize interest on a declining asset. You sacrifice flexibility. You increase long-term risk. You reduce resilience. You trade wealth-building potential for short-term comfort. The car feels like freedom, but the loan, that's the leash. And in America, most people don't realize how long that leash really is. The trade-in illusion. Here's something most people don't realize. Dealerships love the phrase, "We'll give you a great trade-in value." It sounds like you're getting money back. But here's what's really happening. When you trade in a finance vehicle early, the dealership pays off your remaining loan balance. But if you owe more than the car is worth, which is common, that leftover balance doesn't disappear. It gets added to your new loan. So let's say you owe $18,000. Your car is worth $14,000. That $4,000 difference gets rolled into your next car loan. Now you're financing a new car plus leftover debt from the old car. This is how people unknowingly stack liabilities. And because the monthly payment still works, they accept it. But long-term, you are constantly financing yesterday's depreciation. The credit score paradox. Here's the irony. Financing a car can improve your credit score. On-time payments, installment account history, credit mix diversity. But improving your credit score does not mean improving your net worth. You can have a 760 credit score and still be financially fragile because credit measures repayment behavior, not wealth accumulation, not liquidity, not investment strength. So many people feel financially responsible because their score goes up, while their balance sheet quietly weakens. That's a dangerous illusion. The lifestyle creep effect. As income increases, expectations increase. Promotion at work, upgrade the car, salary raise, upgrade again. But here's the conflict. Income increases are often incremental. Car upgrades are exponential. A $300 monthly payment becomes $500, then $700, then $850. Each jump feels justified. But the difference between $300 and $800 per month invested over 10 years, that could be hundreds of thousands of dollars. Lifestyle creep doesn't destroy wealth overnight. It erodes it slowly, and auto financing accelerates that erosion. Insurance escalation. Most people underestimate insurance. Newer finance vehicles require full coverage, which means collision comprehensive gap insurance. And in some states, insurance premiums have surged dramatically, so your $700 payment isn't isolated. It triggers higher insurance obligations, and if you live in urban areas, rates can exceed $250 to $300 per month. That pushes total transportation cost even higher. The more expensive the vehicle, the higher the stacked obligations. Gap insurance trap. When you're upside down on a car loan, lenders often recommend gap insurance. Gap covers the difference between what you owe and what insurance pays if the car is totaled. On the surface, it sounds smart, but it's insurance protecting a financing structure that already puts you at risk. It's protection layered on top of debt, layered on top of depreciation. You're not reducing risk, you're managing consequences of prior leverage. That complexity is rarely discussed during the excitement of purchase. The long-term wealth gap. Let's compare two people. Person A finances $40,000 car, pays 7 Vink dollars per month, repeats cycle every 6 years. Person B buys reliable used car, invests $500 to $700 per month difference. After 15 years, Person B could potentially accumulate six figures in invested capital. Person A has driven newer vehicles, but has little compounding growth to show for it. The difference isn't intelligence, it's financial structure. Debt redirects cash flow away from compounding, and compounding is where wealth quietly forms. The emotional buying window. Car purchases often happen during emotional peaks. New job, relocation, life milestone, stress moment, end-of-year promotions. Dealership environments amplify urgency. Limited time offers, low APR ads, today-only incentives. Emotion compresses decision-making time, and compressed decision-making increases leverage acceptance. When decisions feel exciting, math feels secondary. That's when long-term commitments get signed fastest. The resale disconnect. People justify expensive vehicles by saying, "I'll just sell it later." But resale value is unpredictable. Market shifts, mileage accumulates, condition changes, demand fluctuates. And if the resale doesn't align with your loan balance, you're stuck. Liquidity decreases when debt remains attached to assets. And in finance, flexibility is power. The economic downturn factor. During economic downturns, asset values drop. Used car prices fluctuate. Loan payments remain fixed. If unemployment rises, debt pressure intensifies. And auto loans don't disappear easily through bankruptcy compared to unsecured debt. So long-term car financing during uncertain economic cycles increases vulnerability. The longer the loan, the longer the exposure. The core summary. So why does it truly suck to finance a car in America? Because it combines depreciation, interest insurance, escalation, opportunity cost, negative equity, risk psychological normalization, lifestyle creep, economic vulnerability, all into one socially accepted financial decision. It doesn't feel extreme, it feels ordinary. But ordinary debt, compounded over time, quietly reshapes financial outcomes. The car feels like freedom, the loan feels manageable, but the long-term math tells a different story. And the math doesn't negotiate. If this video made you think differently about car loans, like and subscribe.